Third objective is financial markets and institutions. This is just how money flows between those who have money, the providers of capital, to those who need money, the borrowers or the users of capital. And the financial markets essentially are matchmakers between those who have money and those who don't have money, make sure the terms fit the risk return profile sought by the investors and are on reasonable terms for the borrowers or the user of capital to pay for that. Who are these people? Households in general are net savers. We in the US tend to be more borrowers than savers, but let's just say in aggregate, we're net savers. The non-financial corporations are net users. So most corporations use capital to grow their businesses. Governments, I hate to say it, are net borrowers because US government is in constant deficit the last 10 to 20 years. And because of that, the US government is burying itself in more and more debt. Financial corporations, they're slightly net borrowers, but almost break even. Financial corporations are banks, insurance companies, and they manage their cost of funds very, very carefully. And they tend to seek lower cost of funds, such as CDs or passbook accounts if you're a bank, and policies or other insurance payments into a fund if you're an insurance company. So financial intermediates and institutions make all this happen. So here's a graphical depiction of how it looks. We have three types of transactions. Some are direct transfers from those who have money to those who need money. The second are indirect through an intermediary, in this case, an investment banking. And the third is indirect by use of a financial intermediary that's not an investment bank. Going through each of them in turn. If there is a business that needs money, they could get money directly from a source by issuing commercial paper. By this I mean General Electric can issue in its own name commercial paper saying, I will pay you back $1 million. And people would buy it. Maybe not you or me, but some institutional investors, savvy investors, would be happy to have GE owe them $1 million. So that's commercial paper. The second is investment banking. Investment bankers sit in between people that have money and people that need money. They are the ones that arrange the IPO through the markets and the SEC. They also arrange debt, whether that's public debt like bonds or even private debt in many smaller or specific transactions. And then we have more traditional financial intermediaries like banks who could be issuing a CD. So the saver may get a CD from the bank, which is essentially loaning money to the bank at a fixed rate of return. The bank in turn is now open for business and lends money to a business, or I guess it could be individuals too if it's a bank, for a higher interest rate. If it pays you 1% on your CD and it loans it at 7% for a car loan, that spread is the amount that will go toward covering the overhead and profit of the bank. That's how banks exist. Cost of money for investors. For debt, as we saw earlier with the WACC example, debt is the interest rate. The cost of debt is interest rate. Cost of equity is what is the return that a shareholder gets, and it equals the dividend yield plus the capital gain. Capital gain is how much did your investment go up, hopefully, in value. So if you bought something, a share of stock for $10, and every year you got $1 in dividends, you got some return, 10% return, by a dividend yield. But that's not why you bought that stock. You bought that stock because you think it's going to go from 10 to 15 to 20. So your components of return are dividends and capital gain. The types of securities, we've already talked about these. Debt is loans that we normally, when we say debt, we normally mean debt from a bank or a financial intermediary. Debt can also be a bond. So if it's a capital market security, a bond, then it is, again, a loan with a certain regulatory process and terms. And then there's a money market security. These are these shorter term instruments. We talked about one earlier with the GE example with commercial paper. Equity, stock, it's called residual claims, which means you get the leftovers. Now, if a company does very, very well, and it liquidates, it's going to pay off its bills and have a lot of money left over. If you're the residual owner of Apple or Google, you're feeling very good. However, what if you're a residual owner of a company that's struggling and not doing well at all? By the time you pay off all the people that you owe money to and all your bankers and all your bondholders, you may be left with little or nothing. If you're common shareholders, you may have high upside if you hit it well with Google or Apple, or it could be not doing so well if you buy a company that's struggling or going out of business. So that's why equity has higher risk and therefore demands and should demand higher returns. Derivatives are a type of security, which, and the name kind of tells you what it is. The value of a derivative is derived from something else. Could be something that's a physical commodity. An example could be jet fuel or corn or orange juice. Or it could be something that we have a traded value, such as foreign currency or the value of the stock market. So derivatives can be based on anything that is ascertainable in value, but not right now. There's a time component to derivatives. And the reason these complicated instruments exist is that they're very useful in controlling or minimizing uncontrollable risk. If you're an airline like Southwest Airline, you're really at the mercy of the fuel markets on what jet fuel would be. So if you're out there selling tickets to fly from SFO to New York a year out and the jet fuel prices go up, now you're exposed. So what hedging allows you to do is you use derivatives to buy jet fuel out a year from now so that you're not exposed to the whims of the jet fuel markets. Derivatives are used to reduce the risk for things that are uncontrollable, like jet fuel for Southwest Airline, or flour for a baker, or sugar for a candy maker. So a related topic is securitization. Securitization may seem like a bad word these days because of the debacle in 2008, but it's basically a set of assets, typically loans or receivables, that you bundle together and sell in a large chunk to the capital markets. And it takes something that's very illiquid and it creates liquidity. And the liquidity is just cash. If you sell cars, if you're Ford Motor Company, and you're selling a lot of cars on 3 and 5 year leases, it's great. You sold a bunch of cars. However, you didn't get the cash. All you got is paper from all these individuals that bought cars. What if you took the stack of all those loans and you sold them in a big block and get $200 million for your stack of car loans? Now you're talking, right? You sold the cars and you don't have to wait 3 to 5 years to get your money. You can bundle it, sell it at a slight discount to the bondholders, and you got cash. So that's why securitization is so powerful. It allows companies to gain liquidity and put money back into their business and churn through and generate more money. That's the beauty of securitization. There are also a lot of risk and abuses, but in its abstract form, it's a perfectly okay thing to do.